Welcome to the second part of the interest rate and bond valuation. In this part, we are going to learn and review the legal aspects of bond financing and bond cost. We're going to also look at different features such as yields, prices, popular types, and international issues of corporate bonds. So corporate bond is a long-term debt instrument indicating that a corporation has borrowed certain amount of money and promises to repay it in the future under clearly defined terms. These terms we are going to look in a minute. However, what is the form of a bond? It's like a piece of paper, and you can think of it different aspects of it. For instance, it will be written Microsoft here. I'm taking an example of Microsoft, and then MSFT is the ticker symbol of Microsoft. Then it's amount. So normally US bonds are $1,000 denominated. Now we can have interest rates. So coupon interest rate like 3% per annum or per year will be paid. Now this 3% is what we call the coupon interest rate, which will be periodically paid until the maturity. Oh, the maturity. Now maturity is, let's say, 5 years. That's what we call the maturity of the bond. At the maturity, the investor will receive the principal payment, which is 5,000, which he paid initially to acquire the bond, plus the last interest payment that will be due, and that will be paid with the principal payment. So last payment always includes the principal plus the last interest payment. Then comes whether this bond is, when this 3% is payable, it is uh, annually payable or semi-annually payable. So this will be quarterly payable or monthly payable, that will be mentioned here. So this is there are different terms for this. For instance, bonds par value or face value is also called the payment principal value, and the interest rate is normally called coupon interest rate. Now let's look at other aspects of the bond. Bond indenture is a legal document that specifies both the rights of the bondholders and the duties of the issuing corporation. So what are the rights of the bondholders? They should receive the interest in time. When the term to maturity arrives, they should get the full principal payment plus the last interest payment. Now, what are the standard debt provisions? Let's look at it. These are the provision in a bond indenture specifying certain record keeping and general business practices that the bond issuer must follow. And normally they do not place a burden on financially sound business. So these are just the process and procedures of maintaining bond and bond records. Then comes the restrictive covenants. These are the covenants normally that create risk or for the investors. So these are the provision in a bond venture that place operating and financial constraints on the borrower. So if they break these constraints, my risk will increase as an investor, and hence the premium should increase as well. The most common restrictive covenants are as follows. So for instance, if a bond is issued by the firm, they will be required to maintain a minimum level of liquidity to ensure against loan defaults. So you see the current ratio comes into action here. Prohibit the sale of account receivable and to generate cash. Selling receivable could cause a long-run cash shortage if proceeds were used to meet current obligation. Then we have imposed fixed asset restrictions. The borrower must maintain a specified level of fixed assets to guarantee its ability to repay the bonds. One way to think is that the borrower is actually selling long-run assets for some reason, and if they default, there will be nothing to sell to pay back the bondholders. Hence, this fixed assets serve as a guarantee and they should be there. So any sale will be subject to certain restrictions. Constraint subsequent borrowing. If too much borrowing can create risk for the earlier investors. So if a firm issues the bond once, then twice, then three times as of a large amount, the first series 1 bond holders will have risk will start increasing. And this is to contain this, we have to look at this provision, which means they have to constrain subsequent borrowing. There is also a concept of subordination, which means that the subsequent creditors agree to wait until all claims of the senior debt are satisfied. Which means uh, if as a firm I issue second series of bonds, the first series, so I will my investors will agree that uh, first series bond will be satisfied in case of a default, their claims will be satisfied, and only then the second series debt will be paid back. Then we have a limit, the firm's annual cash dividend payments to be a specified percentage or amount. A firm who has a high debt and cannot pay its interest and paying cash dividend, and if they pay this cash dividend, it will be inconsistent. So in that case, the firms has to limit the annual cash dividend. Next is sinking fund requirements. Now, this is the most restrictive provision. What it does is that a firm has to fill in the bucket. Fill in the bucket, which means the principal and interest payment account that has to be periodically fill in so that at the time of payment the firm has no problem in paying back. It also assures the investors, the bond holders, that they will be paid in time. Within this is a security interest, is a provision within the bond indenture that identifies any collateral pledge against the bond. So there are special bonds which are issued against certain assets, and how it is to be maintained. The protection of bond collateral is crucial to guarantee and safety of an issue. Then comes the trustee. Normally, whenever a large bond issue is issued, the trustee is appointed, who is a paid individual, can be a corporation or a commercial bank trust department that act as a third party to a bond indenture and can take specified actions on behalf of the bondholders if the term of the indentures are violated. And normally, trustees can also have a seat on the board when it comes to the decisions related to the indentures or the violation of any restrictions within the indenture. So the cost of bonds to the issuer. In general, the longer the bond's maturity, the higher the interest rates. Even longer, the more uncertainty, the less liquidity, and the higher the interest rate it would be. In addition, the larger the size of the offering, the lower will be the costs. So it has to do with the economies of scale. Also, the greater the default risk of the issuing firm, the higher the cost. That's what we already know from the credit rating phenomena. Finally, the cost of money in the capital market is the basis for determining a bond's coupon interest rates. So it's basically uh, the demand and supply of the uh, firm's bond, and its price. It's the demand will determine and the supply will determine eventually the cost of money of the bonds of a firm. Then comes the conversion features. Now, a conversion feature for convertible bonds allows the bondholders to change. So this allows means that this is the right granted to the bondholders. Now, bondholders can change each bond into a stated number of shares of common stock. A simple example would be if I hold a 10 bonds, 10 bonds, each worth $10. Then I will have $100 invested in bonds, and I can convert, if the conversion feature is attached to these bonds, then I can convert $100 into stocks. Now I need a firm stock price. Let's say if stock price is $5, then I can convert the $100 bonds into stocks. That will be $5, that gives me 20 stocks. Now one has to keep in mind that that bondholders will only exercise this option, which is the right to convert, when the market price of the stock is greater than the conversion price. Then there is a call feature. Now these are derivative instruments, basically the conversion features or call feature, where we are getting a simply basic idea of it. A call feature, which is included in nearly all the corporate bonds issues, gives the issuer the opportunity to repurchase bonds at a stated call price prior to maturity. So this creates a risk for the investor as well. So issuer can issuer can say, please return my bonds. This is the prior to maturity, and take your money plus whatever the outstanding interest rate is. Now, why would they do this? They would do only when the bond, when it's in their benefit to do so. This means that the interest rates are lower in the market while the issuer is offering higher interest rate. So issuer is offering higher interest rate while the market is offering low interest rates. So what they will do, the issuer will buy back the bonds and resell the bonds at a lower interest rate. This will reduce their cost of fund. The call feature has certain other definitions, such as call price, which is the stated price at which the bond may be repurchased, and then we have a call premium, which is the amount by which the bond's call price exceeds its par value. In general, the call premium is equal to 1 year coupon interest rate and compensates the holder and for having it called prior to maturity. So obviously, if a bond is called prior to maturity, some compensation has to be offered to the bond holders, and that is basically the call premium. Furthermore, issuers will exercise the call feature when interest rate fall and the issuers can refund the issue at a lower cost. As I told you that interest rates, if interest rates in the market interest rate falls, then the issuer will call and buy back the bonds and issue at a lower interest rate to reduce their cost of funds. Issuer typically must pay a higher rate to investor for the call feature compared to the issues without features. This is because of the attached feature. Next look at the stock purchase warrants. Now these are the instruments that give their holders the right to purchase a certain number of shares of the issuer's common stock. So purchase the issuer's common stocks as well at a price as over a certain period of time. Now these are called sweeteners. These, including warrants, typically allows the firms to raise debt at a lower cost than would be possible in their absence. Because if the firm's stock price increases, stock price purchase warrants allows them to purchase a certain number of shares at a specified price. So this price must be lower than the market price in order for the investor to make certain benefit out of it. Now there are three types of yields very common in bonds: the current yield, yield to maturity, and yield to call. Because most corporate bonds are purchased and held by institutional investors such as banks, insurance companies, and mutual funds, rather than individual investors, bond trading and price data are not readily available to individuals. So when you Google, you will have to really go to Yahoo Finance and to find the bond yields, but they are not as readily available as stock market data is available. We'll look into all the three yields one after another. Here's the data on selected bonds, and you can see that we have a company, and the company name is actually the bond issuers, the issuer name. We have coupon payments, we have maturities given, then we have a price and yield to maturity. Please remember that we will use another term called IRR, internal rate of return, for YTM as well. These are different nomenclatures, however, pointing to the same concepts. Let's look at the pricing. So, although most corporate bonds are issued with a par or face value of 1000, all bonds are quoted as a percentage of par. So you can see that if a $1,000 par value bond quoted as 1994.07, so how do we come to this 94.07? It is priced as 940.07, and this is 94.07% multiplied by 1000, and you will get 940.07. This is the price, while quoted is 94.007. So basically it is quoted in percentage. Corporate bonds are quoted in dollars and cents. Thus company C's price of 10143 for the day was 1031.43. That is, 103.143% multiplied by 1000. You can see that this is the quoted in the percentage. And here, however, when you calculate the price, you have to convert it into thousand, which means you multiply this with 1000. So you take percentage and then you multiply by 1000, and you will get the 1031.43, which is the bond value or price. So Moody and Standards Poor's bond ratings. These are the credit rating companies. In US, so Moody's and Standard and Poor's, which is S&P. So they issue different, they issue the ratings. However, they differ in certain ways, although broadly they are same. So you can see I can draw this line for the premium grade. I can draw this line for the speculative. However, you can see a BAA, which is a medium grade, is equal to the triple B grade of the Standard and Poor. So these differences has to be identified. It's easier to know that what Moody's is issuing and what Standard and Poor is issuing, and they are almost the same um, in terms of rating, or symbols are different. So this is a big question. Can we trust the bond raters? Now, let me, you can also look at this question. This is very important for you to think about it. I'm leaving this for you to think about it, but just look at one thing. Credit rating companies rate does the rating of a firm, let's say in December 2018. So all the data prior to 2018 has been used in calculating the credit rating, and it came out to be triple double A. Now in 2019 something happens. Let's assume that a crisis comes, some sort of a crisis. Now in 2019, credit rating or bond raters could not know that certain shock can actually take the firm with a surprise, and they are now unable to pay, or they default on they are probably going to default. So the bond raters work on the historical data with some level of forward-looking models that they are using. However, largely crisis or severe crisis like 2008 financial crisis, which is also called subprime mortgage crisis or the global crisis. After that, there was a severe recession, and later on we have this pandemic. These crises could not have been foreseen by the credit rating companies. Hence, they cannot clearly show that how much a firm can absorb a shock, and hence they are backward looking and not so much forward looking, and so are relying on credit rating companies has to come with a pinch of salt, that their results could be biased in favor of backward data or historical data, and hence total relying on the credit rating companies would be questionable. Let's look at the characteristic and priority of lender's claim. This is important in identifying who gets what if the company defaults. Now we have unsecured bonds. In unsecured bonds, there are debentures, subordinate debentures, and income bonds. These are the terms that you have to remember. Now, unsecured bonds that only credit-worthy firms can issue. And convertible bonds are normally debentures. Now, the claims are the same as those of general creditor. When they default, you'll be, not on the top of the rank. may have other unsecured bonds subordinated to them. Then comes the subordinated debentures. Now they are the second in line, and then the income bonds, which are the payment of interest is required only when earnings are available. This is the third in the line, and they all have general creditors claim, which means they will be paid after the senior debt has been paid. So they are lower in the rank. Then comes the secured bonds. So on the whole, you can see that the secured bonds will be paid first and then the unsecured. Within unsecured, you have the payment will be done first to the debentures and then subordinate debenture and then income bonds. Within the secured bonds, we have the mortgage bonds, collateral trust bonds, equipment trust certificates. These are secured by certain assets, hence they will be paid first. So mortgage bonds secured by real estate or buildings, and then collateral trust bonds, which is, there is secured by stocks or bonds that are owned by the issuers. Collateral value is generally 25% to 35% greater than the bond's value. Then comes the equipment trust certificates, which is used to finance rolling stock. Rolling stock means like oil stock, an inventory of oil or something else, metals, etc. Now, such as aeroplane, trucks, boats, railroad cars, a trustee buys the assets with funds raised through the sale of trust certificates and then leases it to the firm. And this is more in the manufacturing industry. Companies and governments borrow internationally by issuing bonds in two principal financial markets. Now, in a euro bond is a bond issued by an international borrower and sold to invest in countries with currencies other than the currency in which the bond is denominated. It means that if a US company raise debt or sells the bond, dollar denominated bond to and sell it to UK investors. UK investors. The other is the foreign bond, which is a bond issued in a host country financial markets in the host country currency by a foreign borrower. So if a US company, a US firm issues the bond in UK in pounds, So that's the foreign bond market. Both markets give borrowers the opportunity to obtain large amounts of long-term debt financing quickly and in the currency of their choice with a flexible repayment terms. Now let's look at few of the bonds. We have already covered few. We'll look into this. So zero or low coupon bonds. In a zero coupon bond, there are no coupons, so no interest payment. So how do we benefit from such a bond? Is that these bonds have a face value or par value, and they are issued at a deep discount from the par value. And so when we buy it, let's say $100 um, zero coupon bond is bought at $90. So the difference will be what we are going to receive as a yield. On maturity, I will receive 100. I bought it at 90, so the $10 will be my yield. Now there are junk bonds, which is rated BA or lower by Moody's, or BB or lower by Standard & Poor's. Now they are commonly used by rapidly growing firms to obtain growth capital, most often as a way to finance mergers and takeovers. They are highly risky, hence high premiums are expected on these bonds. Floating rate bonds, these are normally have a stated interest rate, for instance 5%, and then there will be a floating rate, which means either it could be linked to inflation or it could be linked to LIBOR, London Interbank Offer Rate. The LIBOR, whatever LIBOR would be at the time of payment of coupon, that will be added. Let's say it's 2%, then it will be the total will be 7% that will be paid as an interest payment. It's also possible that its LIBOR is zero, very zero, then there will be minimum 5% is interest rate will be definitely paid. The rest is depending on what the LIBOR rate is. There are extendable notes. These are short-term maturities, typically 1 to 5 years long, and that can be renewed for a similar period at the option of the holders. And similar to floating rate bond, an issue might be a series of 3 years renewable notes over a period of 15 years, so on and so forth. They can be renewed. Putable bonds. So we remember, if you remember, callable bonds were the ones that issued or attached as a feature with the bonds by the issuer, and it is in the interest of the issuer to call the bonds when the interest rate, market interest rate, is lower and the issuer is paying higher interest rate. They will use these callable bonds to reduce the cost of funds. Putable bond is the opposite of callable bond. It is the right given to the investor or bondholder. So the bondholder can force the issuer to buy back the bonds at a stated at a stated at a stated price. So bonds can then be redeemed at par, typically 1,000 at the option of their holder, either at specific dates after the date of issue and every 1 to 5 years. So there are other characteristics attached to these bonds. But the bigger idea is that the bondholder asks the issuers to buy back at a certain price. Normally, typically is a $1,000 par value. Why would they do this? Now, this is one of the questions that I don't want to miss. If the market interest rates, are higher and the firm bonds have a low interest rate, so the investor would want to get out of firm's bond and buy the bonds which are offered at a market interest rate to uh, increase their returns. So this is the chapter in which we have covered the legal aspects of bond financing, looked at the bond cost. We've also looked at certain features like yields, prices, ratings, and then we have also looked at some of the international issue of corporate bonds and different types of bonds as well we have looked at. And in the next session, we are going to look at how to perform the pricing and how to calculate the bond value, yield to maturity, or other unknowns as well. Thank you.